Let's talk to the head of strategy at Arbuthnot Securities, James Ferguson. Hi, James. Are you closer to regaining some sort of semblance of confidence in the Greek economy or not?
No, I think this is the whole problem with the peripheral Greek countries. They joined the EU. They're now fixed in terms of exchange rates. The normal way, therefore, of getting out of any economic imbalances is blocked. So now we have to come up with an abnormal way, and there's only two ways out. You either increase the federalism of Europe, and they accept money transfers from the Germans, and the Germans have to accept
which might happen one day further down the line.
Well, I mean, you know, the Germans are fairly fresh from the reunification of their country, and they didn't enjoy that long, painful and expensive period, so I don't think they're going to vote for that.
Right.
The Greeks aren't going to vote for the constraints that come with it, so we have to find some temporary plays to put in place, and we're coming up with some temporary plays right now.
And temporary, it seems to be the sort of the word of the day, doesn't it? Because a year ago in May, you would have thought that 110 billion euro bailout would be it, and the crisis would have ended. But as we've seen, it's returned not just to Greece, but it's spread to other countries. So,
well, the trouble is there are several countries which are running primary deficits, which means even if you transfer the money to them, that only fills the hole today, and then they keep digging more and more holes into the future. The way that you normally restructure your economy, as I said, would be to change the currency. Otherwise, you've got to come up with some fairly painful restructurings or accept these permanent transfers, which mean that they have to have a flow, not a one-off payment. So I think in the interim, if you're going to stop countries actually leaving, which would bankrupt too many banks, and you can't encourage the German populace to do these large money transfers, you're going to have to come up with, I think the latest phrase is reprofiling.
Yeah, of course, that was the one that Jean-Claude Juncker came up with. Amidst all this uncertainty, investing, strategy, how would you recommend?
I think the important thing to realise is that the people who set up the euro never listened to the economists in the first place, so they're not going to listen to them now, that all the things the economists said would happen are happening. Our view very much is that for the time being, although the sovereign debt crisis is taken centre stage in the press, we're talking about it here, we've been talking about it for months and months and months, and we'll continue to probably talk about it for several months into the future. This is one particular problem where they are able and incentivised to hide the problem fairly well. At least in the sense of finding ways of extending it into the never-never. Reprofiling seems to be no more than a fancy word for restructuring. And restructuring is no more than a fancy word for defaulting.
Yes, of course.
You just say, look, I can't pay you back. But instead of admitting I can't pay you back, let's extend my loan into the future, and then it won't be an issue that I can't pay back until the later maturity. And of course, much later, those loans can be forgiven. So this is all part of a process, really, of sort of a managed default. But at the same time, it stops the vital thing from not happening, which is that the banks have to mark down the value of these securities.
Yeah, and that's the thing that needs to happen. I mean, stocks have fallen 4 days running. That's the worst stretch in 2 months, James. Do we dip our toes back in?
Well, I think the thing is that stocks have fallen for 4 days running because we're on the back of an extremely long run. It's starting to look a little bit tired. We're also about to see fiscal austerity measures kick in later in the year in America, already in the UK. The economic growth numbers are running out of puff in most countries, Germany probably a notable exception. And as a consequence, we really don't know what will happen next when these sort of the fiscal boost eases off a bit. And the likelihood is that GDP numbers will slow down even more. So having had a good run, the markets are now at a high level, just as things might be turning a little bit worse. So
you're not painting a very rosy picture, are you? Give us some light at the end of the tunnel somewhere.
Well, first and foremost, there's no reason to suspect that we're going to have a calamity. Don't forget, this can all be managed. So if economies are much weaker than expected in the face of fiscal austerity, we could always turn some of those taps back on again. The likelihood is that we're going to have subpar growth rather than any calamitous double-dip recession. In that environment, though, it may be true that the stocks you want to go for are different to the sort of stocks you buy when you think we're having a powerful V-shaped recovery that's self-sustaining. So I think the real risk in the equity markets is not so much a sell-off on the indices as a real mix-up and change of leadership within the indices.
James, thanks for joining us today. James Ferguson, the head of strategy at Arbuthnot.